What if compliance wasn't something you bolt on, but it was something you embed that is programmable, it's privacy preserving in real time at the infrastructure level?
The reason we wrote this white paper is because the regulators proactively asked about it.
Welcome to Conversation and Insights, and today I'm excited for my guest and the topic, which is around programmable compliance. Surely everybody agrees that the digital transformation in financial services this era is all about the infrastructure layer. And as I highlighted in a recent video called The Holy Trinity, in my opinion, it's about the tension between open and permissionless infrastructures and permissioned infrastructures. It's about standards, establishing standards, and it's also about the convergence of AI and blockchain. And this is a mouthful, but it is all touching on stablecoins, tokenization, real-time settlement, and the compliance infrastructure, which, by the way, is inherited from an old era. And this is the topic that we will be discussing today with Beth. What if compliance wasn't something you bolt on, but it was something you embed that is programmable, it's privacy preserving in real time at the infrastructure level? This is the topic that I'm excited to discuss with Beth Haddock. Welcome, Beth. Thank you for joining us.
A pleasure. Thank you for having me.
And for our listeners, Beth is one of the sharpest legal and strategic minds in our industry. She has been involved in fintech and digital assets in many different ways. She's the general counsel of the WealthTech AdvisorEngine. She advises DeFi projects from Grayscale to Orca. What else? You're on the board of a stablecoin issuer. Which is that issuer?
I am. It's a wholly owned subsidiary of a Japanese publicly traded company called GMO-Internet, and it's a prudentially regulated stablecoin out of the US in New York.
Okay. And you're also involved in the nonprofit industry body called the Stable Standard, and you just issued through that body a white paper that I really want to discuss today, titled Programmable Compliance for Digital Money and Assets, a RegTech framework for privacy, resilience, and regulatory readiness. That's a mouthful. Let's start by telling our listeners, what does the standard, the Stablecoin Standard body actually do? What's its focus and mission?
Thank you for that intro. It is a mouthful, but we're hoping if one doesn't have enough time to read the entire paper, you get the crux in that title. And that really is what the Stablecoin Standard and a lot of my work is about, which is this intersection between technology, finance, and policy. So as we look around and there's so many exciting opportunities, we wanted to create a body of work that regulators and policymakers could read and get a little bit more informed about what we see are opportunities as well as risks. So the Stablecoin Standard is a group where it's a fairly large group of issuers and then partners or service providers to stablecoins, as well as in the last year and a half, it's expanded to those that are stablecoin curious as well. So it's an all volunteer group. People get together. I head up the policy arm that created this white paper. And as we were thinking about what could we bring value about, it was the moment where everyone really wants to make sure innovation in the digital asset space is responsible, but how do we do it in a way in which it leverages the new technology. So that's what the Stablecoin Standard is about, and really how the idea for the white paper came as a Genius Act comment letter that we had submitted. And we were really interested in giving a little bit of information and having a discussion about making sure we rethink the paradigm for compliance because we have all this new technology, which is pretty different than the last generation of what you could do with compliance.
I've highlighted a lot of the parts in the white paper, and one that stuck, especially in the introduction, is that you say that the compliance systems that we have today were designed for closed loop systems with intermediaries, static rules, and periodic reviews. This is hitting to the core, the batch processing, more importantly, these closed loop systems. So what is specifically broken about this framework, especially when we're thinking, let's start about anti-money laundering, the way it's been done in these closed loop systems with the intermediaries, batch processing, and so on.
Yeah, thank you for the question. Such an important one. Just like your background, I spent quite a long time in traditional finance and I headed up regulatory compliance teams. So I'm uniquely positioned to understand how we can do better. So I'm an eternal optimist. So I'm going to say this is an opportunity. When we realized that we needed to do a good job fighting illicit finance, and there was increased requirements on anti-money laundering and sanctions and the rest, there was this mass effort to collect information. And when we think about the European leadership, which is very admirable and has been copied throughout the world to protect information, personal information, even GDPR started with the assumption that now we can second guess. But the assumption was you need to collect all this personal information. It's necessary to fight illicit finance. So GDPR and all of the other privacy preserving efforts are based on consent of the individual. But when in actuality, if you want to have access to the finance system, you actually don't have a choice. You have to give consent in order for this information to be collected.
Yes,
That this
so it's really a fallacy that there's a consent here. You have to do it, right?
if you want access, you need to do it. And many believe that out of the financial crisis in 2008 and the lack of the trust, like that's just one of the dynamics. Now we're in the moment with the transparency of blockchain, with all these new regulations coming, and the regulators saying, okay, can we use this new technology to have a different foundation where you don't have to have an assumption that all that information needs to be collected? I'm sure your audience is well aware, but one of the major risks are you make all the individuals vulnerable to all of these different breaches.
Yes.
Yeah. And
You create a huge honeypot, right? And you're inviting scammers, cyber attackers, whether they are groups or governments or whatever, right?
yeah, and we all know the risks. They're real, and it's an inherent risk. I would offer that regulators and policymakers now have a moment to rethink that because you don't need to start from there if you embed compliance and if you embed in the framework a rethink of what Bank Secrecy Act is or the anti-money laundering framework of FATF and some of the others. And what we did find with the paper is that there are a lot of innovators out there in the RegTech space that are considering how they can do that at different points along the compliance workflow. And to me, the most important one and the problem is the prevent layer that we just talked about. We've broken it down into prevent, detect, trace, and protect.
Protect. So this
Yeah.
is a taxonomy to help us think of how the RegTech stack, if you want, tech stack, is how it's structured right now, because from what I understand in the paper, there isn't a full stack solution. There's these modules, and you've created this taxonomy, right, to help us think through that. So it's not a single solution.
Precisely, and I think that's the opportunity. We've broken it down into these four categories because the market has fractured in that way.
Fragmented
So,
again.
yeah, and so the market is ripe if you are an innovator and you're thinking about how you can help bring about value in this time, which I do think is a really pivotal moment in 2026. You need to look at those four stages. And if you're in the compliance realm, or if you're an innovator and you're trying to build, it is a blocker, it is a friction because you have to get more than one service provider. They're all early stage. They need a lot of care and feeding. So that's one of the reasons why we wanted to highlight the fragmentation, because we think it's an opportunity for someone to be able to offer at each and every stage so that you don't need to layer on a stack, or at least the layering can be more effective or minimal with less friction.
Yeah. Can we go through a stack? You say first prevent.
Yeah, so when we think about collecting of personal information, know your customer, and all of those other terms, what we were talking about with your last question,
Yeah,
that's the prevent layer.
prevent. They say it's at the onboarding phase, typically.
Yeah, and that's where there's this assumption that the best way to fight illicit finance is to try and have a closed loop, to use your word,
Yeah.
where you decide who gets in are the right people. But as if we zoom out and we think of society, everyone participates in society. We don't decide. You have to be cleared in order to participate. And that's the opportunity with the blockchain. We can prevent without blocking access. And you hear a lot of that when you have the descriptions about Web3 and blockchain. And I think that prevent layer is probably the most important one. And then the other ones are fairly technical in the sense where if you were to flip the paradigm and focus more on transactions and monitoring transactions, that's when you get to the next two levels. Detecting, when you think about blockchain, you can detect because you have that transparency. Tracing is when you go down the level, right? And you can actually trace. So, for instance, if you had some sort of a vulnerability or a breach, you are able to trace through the different blockchains and the transactions. And arguably the market, even there, could consolidate and you could put them both together. But right now, there's a distinction because everyone is taking a workable segment of the requirement. And then protect is is one of the items that I do think gets conflated. But first, I'll describe it, and then we can talk about how sometimes it does get conflated. So, protect is when you think about having cybersecurity, information security, to make sure that it's like the beginning and the end close the circle together in that you're preventing who gets in. You need to monitor through the transactions that somehow someone who was approved doesn't do a transaction that they shouldn't be doing and they have a leakage. And then you need to protect by continuously, we've heard this statement a lot, continuously improving, continuously taking a look at your ecosystem, at your making sure that it is secure and tamper proof. And that's where I would say the two bookends are the ones that were the biggest learning lessons for us in the white paper work. And the two bookends to me are the most interesting from a market perspective. because going to digital IDs and different types of technology, so you don't need to create that honeypot, super interesting, super optimistic. There are some that are already doing that. And then the protect layer. When we look back at 2025 and even 2024, some of the major risks that we see are because of breaches in security, as you had mentioned. It's not just private bad actors, but it's become a geopolitical issue because of state actors.
Yeah.
And if we focus on those two bookends, the protect and the prevent, by rethinking whether or not we really need to collect all this information, to use a phrase that's a little bit overused, I would say it's a win in the sense that you really get to avoid the honeypot, you get to increase the safety of this new technology, which I do think will converge for all of our global finance systems, as well as shore up protection, which arguably hasn't gotten as much attention, press, policy, and regulatory discussion as I'd say it should. We talk a lot, or you hear a lot about fighting illicit finance. My dream would be at the same rate you talk about cybersecurity and the protect layer.
Yeah, yeah. And one of the other highlights when I read the paper was this distinction between when you do anti-money laundering, the process, and that is very different than cybersecurity processes. And it seems so obvious now that we're saying it, but are we actually, is our architecture of compliance really taking that into account? And it isn't right now.
Yeah, and it's an interesting point for a lot of different issues. I love your work because presumably the audience is going to be a mix. It's not just going to be all compliance professionals. We're also living in a world where people are getting their information from lots of different sources. This is because I did spend a lot of time in-house running compliance departments. Now I'm an advisor, and as you mentioned, I'm a board director. And if you're in the trenches, that companies spend a lot of time and effort with false positives.
Yeah.
And so they go between the create capturing the honeypot and having friction at onboarding to sorting through those middle two layers and monitoring with lots of false positives, and then crisis management on the breaches and the vulnerabilities. And unfortunately, if you're a victim of that, a lot of times law enforcement and regulators will come in, and there is some moments and some time where are you a victim, or because you didn't have adequate approach for these topics, are you somehow complicit? And you need to also deal with an investigation as to whether there was negligence. So that distinction is important because even if you could avoid the vulnerabilities or have the regulators understand that cybersecurity is very different, I do think when we have these vulnerabilities or these issues, we'll have a better positioning to really catch the bad actors. We've
Yeah.
seen some change, but as recently as the last 2 or 3 months, at least in my home jurisdiction in the US, the FTC, one of the consumer protection regulators, has brought a case against a blockchain company that was a victim of a cyber theft. And the reason for that enforcement case was because the company or the innovator promoted that it was security first. So their intention may have been security first, but they didn't execute on it. So being out in the public and saying to your users security first and some of the other promises, and then having yourself be vulnerable to a breach ended up creating more risks and liabilities for the company.
Understood. In the paper, Beth, there's a couple of times you reference another paper that was recently published, I believe in October, called Trust Without Intermediaries. And this is not an academic paper. It's a paper written by entrepreneurs, innovators in the industry, and they're talking about how to embed risk controls, again, at the protocol layer, at the infrastructure layer, essentially talking about new risk management solutions in a way. How does this connect to your white paper, this idea of less intermediaries, minimize data collection, reduce the honeypot for the scammers, and have more, not have it as a closed loop system? I don't know. How do these ideas link? Share your thoughts on this.
Yeah, thank you so much for highlighting that paper. I do recommend that in addition to reading our paper, and it is cited there, so it'll be easy for your audience to take a look at. They go hand in glove in the sense that the misperception that you're helping us highlight today is something, it's a global issue. There's been a lot of good discussions in a lot of different forums, but there remains a little bit of a hesitancy or a resistance if you're a regulator or policymaker to let go of the legacy paradigm. So that paper, along with ours, is trying to give more concrete examples so that regulators and policymakers can see something concrete, something pragmatic that's not just optimistic hype about the excitement of the new technology. And really, when you can look at decentralized finance, DeFi, and at its core, some of the attributes are design features to make the use case more secure by its design. So you don't need to bolt on additional compliance controls. There's been a lot of discussion about whether that is really believable and concrete enough that the regulators and the policymakers understand that, because they look at blockchain and crypto and there continues to be breaches and vulnerabilities, arguably at the same rate. Potentially, it's a little bit different because they're really in the forefront, but at the same rate as traditional finance. So it's hard to believe that you don't need belts and suspenders. So that paper, as well as this discussion, is meant to have us, at least in parallel, have the discussion and give as many practical examples as you can.
Yeah, and by the way, your paper has an extensive appendix with RegTech providers in the different categories, and it's not a complete landscape map, but it gives a decent look at how those layers are operating now and maybe where the opportunities are to link these, make them interoperable, and create that solution. That's what you're alluding to. Again, it's like less data centralization or collection. It's more about a secure way and from end to end. What other attributes are you aiming to have? This is what? It's interoperability, it's transparency. What else?
As you've mentioned, it's data mitigation. And to me, the main issue here is that there's so much excitement and policy and regulatory discussion about digital finance. It would really be an opportunity lost if, in having this convergence, which I do think will happen this year, that all finance will converge. So many of traditional finance is using blockchain, so that the terms that you commonly hear or you commonly heard last year DeFi, CeFi, and TradFi. I think we're going to retire and there's going to be this convergence. It would, at least in my opinion, it would be an opportunity lost if we used the legacy paradigm with the new technology. Many of the regulators in Asia, in Europe, in the US are aware of this issue, but what we're doing at the Stablecoin Standard and then with others in my network, as you had mentioned, everyone is trying to give the information and the ideas so that doesn't happen. So the real takeaway from the paper is to be able to have a conversation where we all agree that the opportunities outweigh the risks if you leave the old paradigm behind. We can figure it out, but we do need the market forces to think about the fragmentation so that your stack isn't one at prevent, another at detect, and then a third at trace, and then a fourth at protect. And instead, we are able to really deliver on something that's more effective and more efficient because I do think the giving access broadly to different types of economies and different types of jurisdictions, I don't think the promise of the digital finance realm will really work unless we deliver on that access. And I don't think we can deliver on that access without solving this problem.
Yeah, so I guess this is what you're advocating for as the Genius Act is being extended and there's more policies and regulations coming around the first version, right?
Yeah, and also the good thing about the stablecoin standard is there's many members. A lot of them are in other jurisdictions, and a lot of other jurisdictions have already had different innovation hubs or sandboxes, so that this really is a global issue. And I do think that although this was post-Genius Act and we continue, and there's a lot of discussion about the next US legislation, the Clarity Act, this really is a global issue. And when we look to Hong Kong or Singapore or some other jurisdictions, we are seeing that there's a willingness to have discussions and we just have to continue to give more pragmatic examples to be able to really achieve what our goal is, which is to really have a paradigm that no longer thinks that honeypot is necessary and that we can be secure enough that those that are hesitant because of the cyber breaches, we solve for that. And I'd hate to see it happen because I do see that the legacy system is closed to many in different jurisdictions because what we had talked about was the access issue. So I feel like all three of those issues are interdependencies. The access issue, avoiding the honeypot, and making the system more resilient and secure by separating out the discussion for cybersecurity.
Beth, you brought to mind the fact that a couple of years ago, and this is like 2017, there was an event up here in Davos, not the WEF. It was post-WEF event in March. And it was a lot of people in the blockchain space, early days, and we had wonderful debates where there was a topic and Oxford debates. If you volunteered, you had to take one side, and it could be like, is decentralization good? You had to take that side, and I had to take the side, is decentralization bad? And we would argue, and people would vote, and it was just a lot of fun. And why do I bring this up? Because all that we've discussed could become a debate of that style, saying, so is compliance going to become code? Are you pro or are you against? And a lot of people would use that to argue against maybe your paper because that really catches their attention, but is not looking at the nuances and understanding that we're really talking about a very different architecture and it's not as simple as compliance, give it over to code. I don't know if you agree.
Oh yeah, yeah. First of all, it sounds really fun. I wish I could have been there, and I hope it happens again. We should do this discussion. I agree wholeheartedly, and there's a couple of things that as I listen to your question, I think about. The first one is we haven't talked about AI. Of course, AI is embedded in our white paper, and AI is really the opportunity. We talked a lot about blockchain, but it's AI that really is going to change the paradigm for compliance. I'd say two other points. One is that absolutely, I wrote a book, Triple Bottom Line Compliance. I do believe the paradigm is not on par with the business paradigm. We've advanced on the business side with technology and the way in which we approach it, but the risk or the controls is a little bit behind. If I'm a big advocate for more efficiency, more impact, more effectiveness. So I do believe that we need to change the compliance paradigm. I believed it even around 2017. But I also would say, as I'm sure many others would, is that AI is a tool for humans to use. It isn't it isn't something that is going to replace compliance officers, but it should replace bureaucracy. It should replace false positives. It should replace the need to mitigate one risk and create the other risk, as we were talking about mitigating illicit finance and creating data privacy issues. Because in our world right now, as it's more sophisticated and the speed with which we transact is going to increase, and a little bit of the chaos throughout the world, depending on which jurisdiction and economy that you're in, this topic becomes even more important because that honeypot, it's just going to increase in the speed and the bad actors that could potentially use. And what they can do, they won't be sending you an old-fashioned, very easy to see if you slow down spam email that's misspelled. So
They're
yeah,
much more sophisticated and move faster, and in a way have an asymmetric advantage of trying new things empowered with AI that makes even anything static that you have to deal with financial crime just doesn't work. There's that asymmetry.
yeah. So to me, this is the penultimate intersection between policy, technology, and finance, regulatory finance, because I stand from a position where the compliance officers are those good Samaritans, the public servants that do want to make sure that all the users and the consumers have a fair transaction. And this is going to help that regime because right now they're working with one hand behind their back. They don't have, in many cases, as good a technology as one might see in a UI or user interface or some of the technology when you're transacting. So this is an opportunity to have just as savvy technology when you're doing your commercial transactions as what's in the back office and what is on the compliance realm. It's a big change, but I think it can be positive for the compliance professionals. I think they care about their jobs, they want to do the right thing, and it could even make their job more fun because you're going to go, just like any use of AI, the opportunity is to get out of the trenches in the work that is manual and be able to do higher value work because you have time that you're given back.
Yeah, indeed. Beth, this is a wonderful conversation. We could continue and talk about from the aspect of the regulators and whether they should upgrade in terms of their surveillance and monitoring capabilities, but we would need another episode for that. Before we close, what are you excited about for 2026? Related to this topic or unrelated or both?
I am excited to pick up on your point about the regulators because the reason we wrote this white paper is because the regulators proactively asked about it. So I am excited to take the conversation to the next stage and to have more discussion on the policy front with policymakers and with regulators, because I do think instead of talking about definitions and whether it's possible, we're going to move to how can we do this?
Excellent. Thank you so much. I'm very excited to hear this and see that we're moving to action, and that this was in response to a request from the regulators that are usually always, they're losing points in the market.
Yeah. Thank you so much.